Nilesh Shah, Managing Director at Kotak Mahindra AMC, joins us on the show. Hi Nilesh, good morning. Good to see you win. Well, Trump's tariffs have been announced, at least for now. And it appears, though India is going to be levied at 26-27% or thereabouts, it's at least relatively lower in comparison to our peers. How do you approach the Indian markets from here on?
So one, Nigel, President Trump has proven Sant Tulsidas correct. Sant Tulsidas wrote centuries ago, Samrat ko nahi dos kosai. And President Trump is proving that for weaker nations, WTO is there. For stronger nations, WTO doesn't matter. In fact, he has historically coined new definition of import duty, which is your trade surplus with US divided by your exports to US. That is called import duty. I'm sure we are going to see one Ivy League case study on this new definition. There is one interesting WhatsApp forward which I have received. I haven't checked the authenticity, but it has come from a reasonable source. The US has imposed mass tariffs twice in its history. One was in 1828 and second one was in 1930, roughly about 100 years apart. And both of that resulted into recession or Great Depression. Coincidentally, third tariff mass hike is also coming after 100 years. And as that WhatsApp forward suggested, you need all the people to be dead who remembered the impact of tariff on the economy before you can play that game again. Clearly, this is one game which is lose-lose for not only US, but also for other countries. There will be higher inflation in US if tariffs come into play. There could be impact on growth as supply chain gets disrupted. And this could result into US stock market correcting as the Dow futures and NASDAQ futures are indicating post-announcement of tariff. Half of American household wealth is in US equity, and 2/3 of American economy is driven by consumption. Higher inflation, lower growth, wealth effect evaporating. Could this result into stagflation in US? Well, it won't be called stagflation. It will be called hard lending because US is a developed nation. Effectively, it's a lose-lose situation for the world as the theory of comparative advantages gives way for Make America Great Again. As
Nilesh,
India... Yeah, go ahead.
No, Nilesh, I was just saying that we were so glad you were joining us because you have a knack for putting things most beautifully in the best philosophical manner. And I think on mornings like these, philosophy ultimately comes to help as well. Because, you know, first it was the financial crisis, COVID, and now this all man-made. On November 5, markets were ripping higher. That Trump is great for financial markets. And now where are we? So what would your advice be to investors?
It all depends upon how situation evolves. I will still say picture abhi baki hai. President Trump has not finished. He will continue to make announcements. And it is up to India as to how we leverage this. We have been imposed tariff duty, but it is much lower than most of our peers. In sectors like pharma, there is no tariff impact. In sectors like garment and footwear, soft toys, we could probably get business from our Asian peers. IT sector will get impacted as technology spending slow down if American growth slows down. And we'll have to be also careful about how China, with its massive manufacturing capacity, dumps goods all over the world, including India. I think there is always silver lining in the dark cloud. And if India can go and negotiate with US, especially, by leveraging oil import or defense import and reducing that trade deficit, and also showcasing that, look, in China, where you run more than $500-600 billion deficit, you are not actually able to operate in China as freely. Your Facebook, your Twitter, they are not operating in China, but they all have free runway in India. So if we can negotiate under clause 4 of the order and probably reduce the impact of tariff on us compared to our peers. It's a great opportunity. Markets will carefully watch how government and the entrepreneurs of India capture the opportunity and then take a call. At least as of today, market is not reacting in panic, which is positive.
Okay, so Nilesh, we hope that stability prevails. One quick last question: remind us of the firepower calculation. In all the last 5-6 months of turbulence, it is domestic money that has helped us. Now, if these foreigners keep selling because of this global chaos, then to what extent can you keep buying? What is the average cash level? I remember you saying it was, I think, if I remember, over 2 lakh crores of firepower. But please do share the latest numbers with us.
So, Surabhi, roughly the cash balance has remained around that level. Whatever flows we are getting, it's getting invested in the large cap space mostly, and couple of small and mid cap space where valuations have corrected meaningfully. Within FPI also, we have seen passive turning buyers in the month of March, passive ETFs. I hope it is harbinger of the buying by FPIs on the active side, and if not buying, at least reduction in intensity. Now, please remember that we have firepower, but we are not here to give easy exit to FPIs. If I know their trade side, if I know they are on the selling side, we are going to buy at a lower price, not at a higher price. So money is irrelevant. Once you show the card, the game will be played based on the cards you have on table.
That's an interesting point. And while it could be slightly chaotic in the near term, as an investor in mutual funds, I'm very happy to hear that mutual funds are not here to give easy exits to FPIs, which could be on the run. Who knows how this plays out? But thank you very much for joining in, Nilesh. Always value your perspective. Well.